Good morning, everyone. Dear FC4S members, dear YFC members, distinguished guests, ladies and gentlemen. My name is Manel Bernossi, and it is my absolute pleasure to welcome all of you here to this first edition of the Casablanca Sustainable Finance Dialogue. We are delighted to have you all with us here today, especially those of you who stayed late yesterday evening and still made it on time this morning. A very warm welcome as well to all of you who are watching us on the streaming. Please make sure to interact with us. Please make sure to ask your questions on the comments below. We have a hashtag for this event, Casablanca SFD. Make sure you use that hashtag and the team will be able to track your questions. Today's event caps a very busy week for Casablanca with important conversations going on. And we're really excited for you to be part of this conversation. So without further ado, it is my great pleasure to introduce to you the CEO of Casablanca Finance City, Mr. Saeed Ibrahimi, for his welcome note.
Thank you, Manal. Good morning, everyone. Dear FC4S and YFC representatives and members, dear partners, ladies and gentlemen, distinguished guests. We are delighted to welcome you today in Casablanca for this sustainable finance dialogue. I would like first to express my gratitude to the World Alliance of International Financial Centers, YFC, and the United Nations Financial Centers for Sustainability, FC4S, two renowned networks that chose to host their respective annual General Assemblies yesterday in our city. It's indeed the first time that YFC and FC4S members jointly gather in Africa. We are also meeting today on the eve of COP27 in turbulent times, to say the least. The recent disruptors, such as the COVID-19 pandemic or the war in Ukraine, with its broad and unexpected ripple effects on human lives, energy supply, food security, or macroeconomic stability, remind us of the importance of crisis preparation, management, and resilience. We should all consider such extreme events as a wake-up call, a reminder of how fragile and vulnerable our lives on this planet are, and more importantly, a reminder that climate change is of the utmost priority as we are starting to experience firsthand its unfortunate impacts. The United Nations international climate negotiations are instrumental in setting the stage for dialogue and international cooperation on such critical issue. This framework is precious for sure, yet it is time to walk the talk. And action starts with finance and the green and sustainability transition. We collectively need to do more to mobilize financing and allocate resources towards the green bankable projects for the good of our planet and our communities. No one should be left behind in such endeavor if we want to be successful. And as during the pandemic, no one is safe until we are all safe. Africa is a case in point in this regard. While it has a limited historical responsibility in global warming, the continent remains the most vulnerable to climate change. However, Africa is also the least funded when it comes to green investment flows. On the flip side, business opportunities are abundant on the continent. Energy, agriculture, mobility, infrastructure, you name it. Sustainable finance is a natural match for Africa. This is the context in which we convene today. We need to collectively find actionable outcomes to our most pressing issues. Sure, momentum is continuing to build on green finance. Yet we need to act now to put in place the frame conditions for more inclusive, sustainable, resilient growth pathways. I have the strong conviction that we, as financial centers, thanks to our clustering and catalyst effects, can play a key role in such promising endeavor. I wish you a fruitful and productive conference. Thank you.
Ibrahimi, we need to collectively find actionable outcomes indeed, and we need to do that now. I read this quote by President Adesina not so long ago, and he was saying we should move away from megawatts of talk, which is delivering zero financing for climate adaptation. So to figure out how we can do that as financial centers, I'd like to welcome on stage the moderator of the first dialogue. He's the Africa editor of The Economist, Mr. Jonathan Rosenthal. Please give him a round of applause.
Good morning, bonjour. Welcome to the first session. Before I invite my panelists up, I just want to tell you how thrilled I am to be involved in this and to be moderating. You know, over 25 years as a foreign correspondent, I've covered currency crises, parliamentary coups, toppling of leaders, you know, economic collapse, the IMF stepping in. So it is, you know, with great relief that I'm leaving all of that behind me in London and coming to a country that is well managed and stable and well run. So that's the first reason I'm thrilled. But the bigger reason is just the topic, the enormity of the challenge. I think we've just heard from Said some of the scale of that challenge. I'm not going to say too much about that because the following panels will, but just a statistic of context for Africa in particular, which is that, you know, population growth in Africa is advancing at such a rate that the continent is adding the equivalent of one France to the global population every 2 years. By 2050, 1 in 4 people on the planet will be on this continent. And yet, today, 600 million people, roughly half of Africans, do not have energy. Africa accounts for about 3% of global greenhouse gas emissions, yet has 17% of its population. So there is an enormous financing need, and financial centers are going to play a part in dealing with that. So it gives me great pleasure as well to invite my panelists up, and they're a great panel. So if I could please ask Oscar Njuguna, who's the CEO of the Nairobi International Finance Center, if you would join me next. Miles Selick, CEO of the City UK. Alba Aguilar, if you, the CEO of the Green Finance Advisory Board in Mexico. Tetsuya Inoue, who's the head of policy research at the Financial City Tokyo, and Philippe Richard, who is the head of the International Affairs Director at the Abu Dhabi Global Market. Thank you. Thank you for that welcome. Oscar, I'm going to start with you first. You know what the challenge is. What, you know, or the scale of the challenge, what do you see as the main priorities and opportunities?
Thank you, Jonathan. Good morning, everyone. It's a great pleasure to join you here today. And congratulations to CFC for doing a sterling job over the past 2 and 3 days, and our colleagues at UNFC4S and WIFC. Look, it's a really interesting time, and you're quite right. There's a lot of opportunities. I think from a Kenyan perspective, from an African perspective, we have an opportunity to really make a quantum leap in terms of the development of infrastructure, etc., that can take us to where we need to be without going through some of the transition challenges that other economies are facing. But I think our key challenge is going to be matching capital with the opportunities. That's really the trick for us. And how we are going to go about that, I think, is looking at ways in which we can align incentives to the capital that's looking for a home and sustainable investments, through partnering with international centers, other colleagues. We're doing a lot of work with the City UK, with Abu Dhabi Global Markets. And I think this collaboration is helpful because we struggle with the same issues. And so I think the opportunities lie in the sort of the same place, but really finding ways in which we can match that capital that exists, and then translating that into effective opportunities on the ground. So that's really the biggest challenge. What I'd like to see, I think, is something that is, if you look at COP ahead of us, if we were to lobby for something like a flat rate of, or no tax, no levies on carbon credits, for example. That would really be a change, because then you have everyone looking at carbon credits and other sort of credits as a way to gain some revenue and profitability from the journey that we were trying to embark on. So I'll pause there.
Thank you. Miles, I'm putting the same question to you. Main challenges, main opportunities.
Oscar's covered a lot of those. I think this is a situation that I think offers an opportunity for financial and professional services to do what it does best, which is that it provides a solution to major socio-economic problems. And if you look back at the sort of history of financial services and the sort of the background to financial services, it's around financing trade. I mean, that goes back 2,000 to 3,000 years, if not longer. It's around insurance and so on. If there is a major socio-economic problem or a technological problem or increasingly now an environmental problem, our industry can step in and be part of the solution. And the scale of what we're talking about here, we're talking here about potentially up to $125 trillion that is going to be required to get the globe to net zero. 50 trillion of that is going to be in this decade. There is no government that can do that by itself. And studies suggest that the majority of this financing, up to 3/4, if not more, is going to have to come out of the private sector in some form. So I think that speaks to a partnership domestically, regionally, and internationally between industry, between regulators, between governments, between intergovernmental organizations to unlock that. And Oscar's already talked about with one idea about how you can drive that further. I think it's going to require innovation. I think capital, technology, everybody's very familiar with those. One thing that I think we're not talking about sufficiently is talent. So you talk to a lot of people in the business schools at the moment. You've got young people who want to do things that are innovative. They want to drive companies and ideas that have purpose, that make a difference. They don't always look at financial services as somewhere that you can do that. That's a reputation issue we need to deal with. Some of the echoes from the global financial crisis, I don't think that's a fair perception, but it is a perception that exists, and we need to recognize that. They look to the tech firms, they look to startups, they look to being entrepreneurs, and that's all fantastic. But we also need that expertise inside the kinds of companies and the regulators and governments that can drive this sort of agenda forward. So what are we doing to both grow our own timber in industry and in individual companies, and in countries themselves, but also about making sure that talent can move easily between borders and share that kind of expertise, whether it's through academia, industry, or the public sector.
Thank you. I'm going to go to you next, Tetsuya.
I would like to discuss a little bit about the challenges we face with regard to the transition finance, especially in relation to the climate change, from high level to low level. To begin with the high level, we are still sometimes frustrated about the remaining skepticism of the idea of the transition, probably because its front-loading nature of the cost and investment or some sort. In addition, that it is also linked to the uncertainties with regard to the policy, politics, and technology, you know. These might be the source of the challenges, I think. And the middle level, I think that still the lack of governance over financial institutions as well as non-financial corporation has been a source of the burdens for policy purposes of the transition finance, I think. In terms of the capital markets, you know that the Japanese financial system still lacks the strong basis or framework of corporate governance over even over the listed companies. In addition, for the case of Japan, you know that we are, because of the bank-centric system, I think that the creditor governance over, especially over the small and medium-sized firms, faces a strong difficulty in modifying the attitudes or actions by the borrowers, especially the small and medium firms. And lastly, at the low level, that we need to modify substantially the system of data collection with regard to this, because of you know that while this is it is highly ambitious, but still I think that there's some kind of interoperability or unification of harmonization of data format is especially required in order to efficient conduct of transition finance. So that as a related issue, I think that some kind of collective management of data, relevant data, expressed by my colleague from Frankfurt yesterday, was a very good idea, I think.
Thank you, Tetsuo. I'm going to, before you hand over the mic, I'd like to just nudge you slightly to elaborate, because I think you raised a really interesting point about I suppose ultimately trust, governance trust, and you spoke about it in the context of the Japanese market, but presumably one of the general failures we're seeing in the development of these markets is risk assessment. And I'm quite curious to get your view as to whether you see that as a much wider problem than just Japan, as you described it.
Yeah, thank you. I have a mixed view about that. While we could or should learn the lessons from the advanced economies, especially some countries in European region, but so that we seem to face the same set of challenges in relation to data standardization or treatment of the efficient treatment of data, or some kinds of the policy initiatives, such as showing solid time frame to reduce the greenhouse gas emission in a rational manner.
Thank you. Albert, if I could bring you in, and you're approaching this from a slightly, perhaps slightly different perspective, being sort of perhaps slightly more green-focused in terms of your organization than some of the other speakers. What do you see as the main priorities and challenges?
Yeah, in Mexico we have also the same challenges, I think, with all the emerging markets. And I ought to say that we have a conflict between the short-term issues that we have to address and the long-term sustainability agenda. This is a great challenge for us, trying to resolve the crisis, the inflation, the growth that we need, and the long-term vision is another priority in our market sometimes. And also we have a challenge, but also we have opportunities, great opportunities, as we need to build the green infrastructure that we need in the next years. And this is difficult sometimes because the green infrastructure that we need sometimes in the green field is difficult to finance. No, we have the flows, the investment flows with sustainable labels also, but we don't have enough green projects in the brown field. No, it's difficult because the green field require upfront outliers, and the cost of the capital in the emerging market is higher than other countries. And also we have a portfolio managers that right now is more focused on governance, but less in the environmental and social factors, and they are very focused on what are the company doing about governance, and they don't see anything around the social issues, for example. And also we have rating agencies that has different criteria to measure the ESG scores, and this is very difficult to make a useful this data useful for the investors and also for the investment decisions. We have to work on a very ESG, a very quality for the ESG data. And the last thing, I mean, the lack of clear frameworks in the debt or sovereign bonds. We have sovereign bonds, but we need a specific the activities that they are going to finance. No, we have not clear frameworks. As example, SDG framework is too wide, in my opinion, to have a debt instruments. No, we have to focus on green or social, but we have to care also the integrity and transparency of the market.
Thank you very much. I mean, a clear call, and we'll come back to some of those points on I guess, kind of scoring and transparency, and it seems to be a theme coming up. But Philip, I'm going to hand over to you next in terms of challenges, opportunities, the main priorities.
The difficulty with sustainable finance is that when you start talking about it, then you touch upon many things, and it goes in all directions, if I may say so, sorry. Basically, I take the number mentioned by Miles, you know, I have in mind 9 trillion investment capital yearly to achieve the 2050 net zero. I think your numbers are not far if you add, yeah. So it's a huge amount for emerging market. So how can we do that? The financial centers, they are in between the regulators. I'm a regulator, so I'll come back to that. They are between the regulators and the investor, the professionals somehow. They are in between. So what can we do? And this is Abu Dhabi Global Market, where I work, the International Financial Center of Abu Dhabi. We started this journey, let's say 3 years ago. And you have to be very organized. If not, it goes in all directions. So what we said, and we have not changed over the last 3 years, we said there are 3 dimensions. Regulation, and I may come back to that, what to do in terms of disclosure, definition of product, and so on. Then there was the issue of awareness, how to raise awareness about the net zero, sustainable finance, important issue, and so on. This is another dimension. Then cooperation nationally, internationally. Just to give you an example, I'm chairing the group of all regulators in the UAE, and as it's a federal state, there are a good number of regulators. But we work together because we have to cooperate. If not, it will not work. So that's the C. And then the E is the ecosystem. Ecosystem is the transaction, the business. And so it's RACE, you know, R-A-C-A. It means that we have no time to waste. We have to move on fast. But we have to move on in a very organized manner. And on top of this race, you need to have a strategic direction coming from the leadership, from the government. If not, it will never work. So this is, for me, the parameters that you have to have in mind in order to address opportunities, attract private capital on top of the public funding, and then try to be efficient. I'll stop there. Thank you.
Thank you very much. I'd like to throw a grenade into this conversation. I suppose both of you already have, but you know, between the numbers that Miles and Philippe have suggested, you know, 50 billion by the end of the decade, trillion, 10 trillion a year, we're not getting anywhere close, are we? You know, is this a failure of innovation? Like, you know, where do we go, Miles?
I completely recognise the statistic that Philippe has raised, because I think it's from McKinsey, if I remember correctly, which is that there's 9.2 trillion required each year between now and 2030. And precisely to your point, Jonathan, we're not anywhere near it. We're about halfway. So as, if I recall those McKinsey statistics correctly, we're at 5.7 trillion, and that's the expectation of where we need to get to. So no, we're not near it. The progress that we're making is impressive. We did a report recently with BNP Paribas and Refinitiv based on what. And the point has already been made about the data, which I think is a really important one, and I think we need to come back to it. So there is a problem with the data here, but as best as we can tell, the amount of green finance, broadly defined, was about 5.2 billion a year in 2012. It's now about 540 billion a year. So it's moving in broad terms. So it's moving in the right sort of direction. But it is going to require an enormous effort. Now, some of that is going to have to come from if you like, a convening power from governments. Nobody else can do this. And that's why initiatives such as COP, initiatives such as many of the ones that we've been talking about on this panel already are absolutely critical. But it's one of those areas that, as we move towards what appears to be a period of decoupling or deglobalization in the global economy, we need to be making the case, especially the sorts of people on this panel, the people in government and the people in regulators, that this is an area of global policy that is going to require not competition, but actually very clear cooperation and collaboration. Now, there's inevitably going to be a degree of competition between all the financial centers represented in this room, because we all want to be the foremost financial center for green finance. But that isn't something that you do alone in any case. The nature of financial centers is that they are both competitors and collaborators. But as I say, that's going to require some clear leadership from governments. It's going to require vision. It's also going to require a different approach from regulators. A lot of this space is going to require a different approach on risk. It's going to require a different approach on innovation than I think sometimes regulators are used to. So my sense is we're going to need to do this. We're going to need to do this in cooperation. We're going to need to do this in collaboration. Otherwise, we're not going to get anywhere near the target that's been identified on this panel already. Thank you. Let's continue with this thought, because there are some things that I guess are within the control of the ecosystem. You can clearly talk to governments and perhaps try to influence regulation. But within your ecosystems, what more can you be doing to make this work? Oscar, you seem to be.
So one interesting statistic on Kenya is that our energy mix is about 85 to 90% clean. So it's one of the leading countries in the world that has a clean energy mix based on geothermal, wind, and solar. But, you know, and that sounds really good, and it is really good, but I think that has really grown organically. It was done because that is what was available in the country in terms of innovation. These are the sources of energy that led us to where we are. But what we need, I think, is a more intentional trajectory and actions in that space. So, you know, I keep hopping on about the incentives, but I think that, you know, if there's agreement that we need to take steps, and I think Miles has rightly pointed out, we need to work together, then what are we saying about that? What does that actually mean? Are we going to agree that, you know, there's a sort of stick and carrot approach where we say there must be a global carbon tax, you know, that really then shifts everything to a mandatory sort of compliance market? Or are we going to just be saying that this is, you know, we need to transition, we need to move, we need to take bold steps? And so, you know, I think that the purpose of COP and things like that is to really say, well, what are we going to do next? We need to take hard decisions and then align the incentives, because everybody wants to make money. Financial institutions want to make money, so we have to make it profitable for them to do what they need to do, to fund the massive scale of infrastructure that we need.
Tetsuya, coming back to you, and I suppose on Miles's point about this tension between cooperation and I suppose, you know, and competition. I mean, how do you see that playing out from where you sit? Yeah, and this balance between working together versus competing for flows.
Sure, candidate financial centers, including Hong Kong, Singapore, Shanghai, and the South. So that we need to take a good balance between the competition and cooperation. Of course, that for the purpose of the transition finance, we need to conduct some kind of collaboration, of course. And with this regard, that we revisited the strengths or the source of strengths of Tokyo as an international financial center. We, as the onshore financial center, we are backed by the large-scale real economy, as well as a huge amount of the household assets here, over $30 trillion or something like that. So that we redefine a mandate as the incorporation of the flow of funds or services and flow of funds. This is, according to our terms, that this is an incorporation of investment chain and supply chain.
In a few minutes, I'm going to give the audience an opportunity to ask some questions or raise some comments. So while you're thinking about that, though, I'm just going to turn briefly to Alba and Philippe. And I'm keen to get your view as to whether you feel that this is a bit of a stitch up by the big markets or the big financial centers. Are they in effect setting kind of global rules, global standards that may be perfectly appropriate for their circumstances, but perhaps less appropriate for sort of emerging, developing financial centers such as Mexico, Abu Dhabi?
It's for me. Thank you.
Please.
Yeah, I think the collaboration is the key. We have an important to have common efforts between the public and private sector, and I mean the collaboration is a key for to have a great results. I mean the participants of the financial center as investors or bankers, they need to support their clients in the transition. It's not only put the money and that's it. No, it's a kind of a close dialogue with our client, our clients, all the stakeholders, in order to have the right transition that you need in the business model. And this is, the collaboration is not only for the companies, it's also to have a very close dialogue with the government. We need a common ground to share the efforts in order to have a better results. And if you don't have the government support, the full government support, you need to be active in the private sector. This is key. And in the case of Mexico, for example, we have a close dialogue, but since 2 years, no, it's a very short time. But we in the private sector are working since more years, and this is important not to slow the velocity.
Thank you. Philippe?
Yes. I see your question. It's really, should we have the same regulation for emerging market and developed market? That's a key question. My answer would be, it depends. So, what do I mean by that? If you issue green bonds, the green bonds, you know, we have green bonds issued in Abu Dhabi, but the investors are global investors, and the bonds are listed in London or somewhere else. So then you need to be aligned with best practice and international standards. No way about that. However, if you are talking about SMEs, banking, how to finance the SMEs and on green finance locally, then you have to be much more proportionate and take into account the degree of development of your market. So again, it depends. And I think that behind this question, if I may raise it, there is a big question of the transition. We are realizing that green assets are not that numerous. Well, we have solar plants. In Abu Dhabi, we have many of them, and they are very big, but it's still limited globally. And in fact, the key question is how to green the finance instead of financing the green, because financing the green, well, it's not that difficult. But how to green the finance, this is a transition, big question. So you are helping the transition from brown to green, and in terms of regulation, you have to have rules which give trust to the investor that it's really moving toward the right direction. And this is what we have been talking about these last days in Marrakesh at the IOSCO general meeting. That was a key question. And the key other question was how to fight greenwashing. This is key, because if you don't have the trust, you will never get the $9 trillion yearly we are talking about before.
Yes. I completely agree with what's just been said, and I'm going to, in true essay writing style, I'm going to argue with the question. So I don't think this is stitched up by the big traditional centres at all, quite the contrary. And if you go to the City UK website, and I hope I'll be forgiven the plug, but this is, I think, useful. There is the report I mentioned earlier that we did with BNP Paribas and Refinitiv, and it showed that if you look at this as a proportion of activity in each financial centre, yes, of course, on bonds, the traditional big economic centres, the US and China in particular, are disproportionately influential to a certain degree with Europe. But if you look at VC, if you look at loans, if you look at a variety of other areas, there's some really interesting, fascinating, innovative work happening in places like Mauritius, in places that you wouldn't necessarily think would be seeing this sort of activity, that as a proportion of the economic activity that's going on, the financial activity that's going on in those centres is greater. than in the traditional centres. And I think that's really exciting, because that's where you're going to see the innovation. And then the challenge will be, to the point we've talked about in terms of financial centres cooperating and sharing best practice, is how do you take that and scale it in some of the traditional centres. So I think it's a much better, much more interesting and much more exciting picture than you'd initially expect.
Thank you, that's really interesting. Yes, please. I think it should be on.
Yeah. With regard to the greenwashing, you know that we would like to add the cross-border aspects of greenwashing, because sometimes the large corporations domiciled in major economies inappropriately reallocates the burdens of cost to the suppliers typically located in the emerging economies. That's why I think that the FinCity Tokyo organization decided to discuss the supply chain finance issues from the point of view of transition finance. This might lead to the appropriate reallocation of funds or resources, in addition to the funding needs for emerging economies that has the cross-border aspects.
Thank you. Could you, on that point, could you just perhaps give me an example or two of ways in which Tokyo Finance City has been doing, what sorts of products perhaps, or what sorts of products in terms of the supply chain finance? What are some of the innovations that you're seeing coming out of the process you just described?
Okay, do you know that from every aspect of the policy agenda, you know that the global economies are required to enhance the function of supply chain, especially in terms of the transparency or resiliency of some sort. So that's why we wonder what kind of role the finance could do, as you correctly pointed out. While this is in the area process of discussion, but still I have in mind the revisit or revitalization of asset-based funding instruments to use to reduce the burdens of regulatory the framework on banks. In addition, in the future, I'm also interested in usage of the central bank digital currency as the appropriate instruments to streamline the flow of data as well as the flow of funds.
Thank you. Before we go to the audience, Oscar, do you want to respond to some of what's just been said?
Just on the point that Miles was making about supporting innovation and collaborating between financial centers, which I think is key. And we're looking at initiatives around helping fintechs that are doing sustainable work and enabling them to perhaps cross-list in, say, London, where they can access deeper pools of capital. So I think that is really critical. On the points around reporting and data, it's obviously key. But the more established financial centers are way ahead in terms of reporting around TCFD and things like that. And it'll be a while, I think, before we get institutions, certainly in Kenya and regionally, focused on that type of reporting and making it mandatory. We still have some way, and I think that's really going to be driven by alignment with incentives.
Thank you. If we could go to the audience, is there a roving mic, and if there are any questions or comments, please raise a hand. We have one over there. Do I see any other hands? One in the front. So we'll take two or three. And if I could just ask you to introduce yourself and your institution.
Good morning. My name is Abhijit, and I represent a company in CFC, and also I have a fintech in Berlin. So my question to the panel is, the financial centers play a major role in collaborating private sectors and other players, but to drive the net zero initiative and sustainable finance, do you think is it enough to do the collaboration between all the financial centers, or the financial centers across the globe should also drive to the regulators to frame laws which are similar across the globe so that the net zero target can be achieved? Because some regulators in London or New York may be framing certain laws, but in China or India or in Japan, those laws or frameworks are not available, or even in Africa. So what would be the role of the financial centers in that?
Thank you very much. Could we have the mic in the front, please? Oh, you. Thank you. Sorry, could we have the microphone here? And do I see one more hand? We can take 3. Okay.
Thank you. I just like to voice questions from our audience on social media, and thank you once again to all of those who are following us on YouTube and LinkedIn. So Sarah is asking, is there any unified framework for financial centers to avoid impact washing and green washing? And then Mohammed is asking, what should we do exactly in Africa? What would be your recommendation in order to drive more financial flows to this cause? Thank you.
Thank you. And and one more here, if we could pass the mic along.
Thank you very much. Shouldn't we follow?
Could you introduce yourself? Sorry. Could you just tell us who you are and what your institution is?
I'm Badr Bousabat, Head of Marketing of the World Alliance of International Financial Center.
Thank you.
And I have a question for you. Shouldn't we follow two-step strategy? First, a regional strategy to take into consideration the data around us first, linked to the environment, and then follow a more global strategy between financial centers and governments?
Thank you very much. So I'm going to pass this back to the panel, and I'm going to look for some volunteers on these questions. Thank you, Miles.
Completely agree on the first question. It's absolutely not enough for the private sector to do it by itself. The private sector can't do it by itself. It's going to require collaboration amongst regulators at international level. The reality is that regulators are rightly incentivized to promote financial stability, so sometimes the approach on new areas, on innovation, isn't where it ought to be. I'm reminded of one of the stages when Solvency II was being designed about 10 years ago in the European Union, and I was in insurance at the time, and insurers were actively disincentivized from investing in green technology, from taking green bonds, from having that as part of the capital, and that required an enormous degree of effort from industry, and actually, in fairness, the UK authorities and some of the other authorities in the European Union were helpful on this, to recognize that's something that we ought to be investing in, not being disincentivized from holding from the point of view of regulation. So it's going to require a mindset shift. I'm delighted to say I think that is happening. It's been happening for some time. I think COP26 in Glasgow is a good example of where central banks and regulators are. I think one of the things that's consistent on the other questions that have come up is this importance of a unified framework, this importance of data. And I do worry about the fact that we are creating competing additional forms of measurement in this space, competing taxonomies, and there needs to be an important factor here, which is we need to have a degree of consistency. And we need to have a degree of interoperability between those standards, because otherwise you run the risk of complexity, you run the risk of cost, you run the risk of standard shopping, greenwashing, etc. So the data's critical, but I think it's absolutely vital that we end up with standards that are not just high, but aren't a barrier. And you know, here I look at the work the EU has done recently, for instance, on its taxonomy, which is comprehensive, hugely impressive, but it isn't enormously interoperable, because the do no significant harm provisions are dependent on measurements in EU law. And that's great if you're one of the 27. It's less impressive if you're not.
Thank you. Philippe.
I agree with the question posed and Miles' remarks. By the way, these last days, as I said, I was at the IOSCO General Meeting, not very far from here, And the big question was how to recognize the standards that are being issued by ISSB, you know, the International Sustainable Standard Board, the new creation of IFRS. And IOSCO is going to recognize these standards to have a common framework for the disclosure, because disclosure is a key, you know, is a key to avoid greenwashing. So this is one aspect. The other aspect is that we know that there are several regulators in the world, including us, I must say, working on the definition, designing of transition products, financial products. You know, it could be sustainability-linked bonds or transition funds or things like that, you know, to reflect what I was talking about before, you know, how we can assess the progress on the journey to the full green or the net zero, if you will. So that requires the regulation, the right regulation, and it's part of my 4 dimension. You know, first pillar was regulation. And the financial center, they have to work with the regulators. They work with the investors, the professional, but they also work with the regulators. And I think that financial center, they should take the lead somehow on insurance, that there is this coordination, collaboration, coordination. Thank you.
Thank you. Yes, please. Please.
Especially on the first question. Yeah, actually, I was myself wondering what is the major the driver. What are the major driver for the in order to make sustainable finance sustainable? Yeah, you know that we need to have some sense of value. In addition, that the regulatory pressure will be necessary, but I think that in addition to these, that it's some kind of value economy or economic value is necessary. In other words, that this kind of the transaction financial activities should be well built in the broad-based financial transactions. So in order to this, that in addition to disclosure system or data format or something like that, we need to have the two more major drivers elements. One is the time frame for reducing the carbon, the greenhouse gas emission from the longer period of time, because you know that this in any way requires a huge the long-term efforts to do this. The other is the pricing mechanism of the carbon itself. You know that the politicians or policymakers would like to prioritize a carbon tax or some sort, but at the same time, we would like to have some framework for pricing this asset or liability, I would say, based on the voluntary transactions such as the exchanges or the over-the-counter transactions.
Thank you. You were the first on the panel to mention greenwashing and scoring. So, what are your thoughts about sort of where we are, and I suppose some of the solutions that have been proposed on this panel?
For greenwashing or social washing, I think it's important to have a taxonomies, as we mentioned. Of course, we need a common language for every participant of the financial sector, but we have to be a special importance of the risks, the new risk that we saw in sustainable finance. I mean, climate risk is not only a physical risk, we have a transition risk also. And this is a very important thing in emerging markets, I think, because we are on transition. But the transition is, I believe that must have a deadline, no? The transition means a period and then what happened? We can be on transition indefinitely, no? And in our markets that we are on transition, we need to establish also what are the activities that are transition activities before to be completely green, no? And this is very important because maybe in developing countries it is not the same for developed countries. No, to establish clear what are green, what are transition, and what are social, and all these activities is better to the market, to have a consistency, to have a transparency, and make the flows, the resources come to these projects. No, we need to clear all of these colors in the activities in order to be not to don't have a greenwashing, and the metrics are very, very important.
Thank you. Could you keep your microphone? I'm going to push one of the other questions to you, which was the question of does one take a two-step approach of starting with sort of regional harmonization, I guess, was the question, and then looking for a more international, or does one start at the top? Yes, Alba, if I could. Sorry, the question was, does one start with the regions to harmonize the rules and the scoring, or does one go straight to an international standard?
We also have must have a coordination between international finance centers, and they have the best practices always, and very close dialogue with the international agencies, with the multilateral banks. They have the best practice always, and we need to know exactly and clear the methodologies of the ESG ratings, and sometimes we don't see exactly what are the methodologies that they use, and this is not comparable, not consistent, and this is very difficult to make decisions when you see different scores so far, one from other.
Thank you. Oscar, do you want to jump in on this briefly?
On that question, I think that the issue of taxonomies illustrates the challenges that you have with this. If we're looking at developing individual taxonomies, then where does that take us, especially when we're trying to look at cross-border trade and investment. But I do think you really need to look at some of the local needs and requirements first to have a building block and a baseline that you can then scale and grow. I think the sort of, replicating what's been done somewhere else where they've done a lot more thinking presents challenges. But I think, ultimately, harmonization is going to be critical because people want to do business across borders. So having a unified framework or a lot of similarities makes it much easier to do that. I think ISSB is a great initiative in terms of getting that direction. But to that point, I think you have to look at local needs and then build on that, because that's really how you're going to get buy-in from local institutions and banks, etc.
Great, thank you. There was a question about financial flows to Africa, and I have heard it, but I think we can save that for the next panel, which will be focused directly on that. So, if you on the streaming audience, if you can just be a little bit patient. I'm going to put one last. So it's not really a question. I suppose it's a question. Perhaps it's granting a wish. Sitting next to a portrait of His Excellency the King makes me think of royal prerogative. And if I were to say, imagine that you were monarch of the world for a day, and you could pass one decree in relation to solving the problems we've just discussed for the past 45 minutes. So you've got one wish. What is the one thing you would do or change that can perhaps guide the audience in terms of thinking about what their priorities should be for change? And I'm going to start on the far side. So Philippe, I'm not giving you much chance to think, but
I would avoid taking a decree for the world. I mean, it would not make sense. I mean, because we just talked that, in fact, it goes back to the regional and international dimensions, and they go together, you know. When you develop the regional framework, you have to keep in mind the international standard. They go together. So it's not coming from the very top. In terms of governments, authorities, high-level leadership, I would say the most important is to give this strategic direction, to see, to commit to 2050, for instance, and then provide help providing the public funding to some extent, while having in mind that anyway the private sector is a key player in that journey.
Thank you. Alba?
I will add one wish more, 2 wishes.
Okay.
Okay. And one that is, if we want a new market, because sustainable market is a new market now. If we want some new market, we need standards and rules of the game. And I think this is the condition to have a real market with the scale, with the deep that we need to push our efforts, and also, of course, if we have a same language, it will be better. But if not, we need to explain what are the difference between our language and the other in other international finance center, for example.
Thank you. Tetsuya.
Thank you. Thank you. Yeah, in my view, that I would like the 2 steps approach provided by the audience, because in light of the diversified economic situation or economic resources or the requirement for environmental activities or some sort, it is realistic to conduct this kind of approach for the moment. But that said, you know that during the first stage of the step approach, still we need to have some smooth flow of capital or recycling of national savings across the globe. That's why that we need to have the enhanced understanding what's going on in each or respective financial centers.
Thank you. Miles.
On the basis that battles are always won with the dull logistic stuff, I'm going to offer the dull view, which is it's just getting the data and the classifications and the taxonomies right. Put that in place, everything becomes a lot easier.
Okay, Oscar.
So my magic wand, waving it around, and at COP27 we will have a fixed pricing mechanism for carbon that will start at $50, going up incrementally from there. That's the wand.
Excellent. A number of years ago, a governor of an African central bank, and I shan't mention him or his bank, but he was newly appointed, and he hadn't come up through central banking. It turned out to be a very good central banker, but was was not a central banker by background. So what do you do when you're a new central banker? He went off to, at the time, the maestro, Alan Greenspan, and said, you know, I'm new to the central banking thing. Have you got any words of advice for me? How do I do this job? And Greenspan said to him, there's only one thing you need to know, and that's never say anything. Just don't open your mouth. I think we're very fortunate that our panelists have not had advice from Greenspan, that they have spoken honestly, frankly, eloquently, and clearly about some of the problems and the issues that have to be resolved, but also with some optimism about how to solve them and the role in which financial centers can play in solving these massive problems. So I would like to invite the audience to please join me in thanking the panelists for their insights and brilliance. Thank you.
Thank you. Thank you very much. Thank you. Great first conversation. Thank you, Jonathan, for moderating this first dialogue brilliantly. I personally very much appreciated your magic question, Wish. If I were to answer that question, I would say that probably for each commitment made during the past 26 COPs at an individual level, at a country level, and at a company level, if we were just to keep each of that commitment, I think we would go a long way. So now, before we move on to the second dialogue, we are delighted to have a special address from the former chair of the World Alliance of International Financial Centers. She and the former also co-chair of the FC4S, and she is now CEO of the Women Corporate Directors, which is the world's largest network of women corporate board directors with more than 2,500 members serving on more than 8,500 public and private boards around the globe. Ladies and gentlemen, please join me in welcoming Jennifer Reynolds.
Casablanca Finance City for hosting the annual General Assemblies for both the World Alliance of International Financial Centers and the UN FC4S. It really has been a wonderful couple of days here. You are fantastic hosts, and I'm delighted to have a moment to speak with all of you. I was there for the original meetings for both YFC, as we call it, and for the UN FC4S as we got a group together and sat around the table and said, does it make sense for us as financial centers to work together, to spend time thinking about these huge issues and opportunities that face all of us, and will this collaboration versus competition get us further ahead? And it was unanimous. And as we grew over the last few years, we found more and more financial centers who wanted to join and felt that we were more powerful and we would be far more effective if we were working together. And certainly, as I've seen the progress in both of those networks, I think we do have something special when we're all sitting in the room together and sharing the solutions. And I think when it comes certainly to sustainable finance and the issues that face us with climate, with some of the social issues today, we need to move quickly and we need to learn fast. And so I think we need to look at what's being done in different parts of the world and quickly copy those who are doing things well so that we can get the results that we're looking for quickly. And so, you know, as I think specifically about FC4S and some of the initiatives, I think our assessment tool, which really has measured how are we doing in financial centers on building capacity, on building results, on sustainable finance, and on the goals that we've set for ourselves in terms of sustainability. I think we've seen growth, certainly, in the different elements that we need to see. Everybody is at a different space in that trajectory, depending which country you sit in, depending which region you're in, but certainly across the board, we're seeing an uptick. We're seeing activity happen. I think the question today, though, and it was talked about on the panel today, is just that transparency. If we're driving capital to these different initiatives, are we actually making progress? Are we getting results? And that, I think, right now is the big challenge, as we've heard. And I think that it really is incumbent upon us to make progress quickly there, because the public is looking to us, as financial centers, as of course regulators as well, and different parts of government, but they're really looking to us, I think, in the business world, in the financial world, to show progress, to drive, not only to drive capital, but what are the results that we're achieving by moving this capital to projects which we're calling sustainable, which we're calling putting into the category of ESG. And so I think it's really important to reflect on that, the concept of trust in business and the concept of trust in financial centers. I think it's very important right now. There's a really interesting study that's done once a year on trust. It's a global study. It has about 30,000 people who are interviewed, and it looks at trust in different institutions. So trust in government, trust in the media, trust in NGOs, and trust in business. And it's really interesting because this past year's study showed that generally, the population around the world has increasing expectations around business. They trust business more now than government, more than the media. Trust in the media, trust in government has gone down over this period. And I think that's actually quite fascinating. And when we think about trust and what are they looking to business for, they're looking to business, they're looking to financial institutions to take a stand on climate, to take a stand on social issues, to think about these huge problems that face all of us, long-term, very challenging problems that take collaboration amongst many stakeholders. And they're looking to business to make statements on this and to make progress on that. So that's a very different world from a world where all business leaders were expected to do was to deliver the bottom line, to deliver share price appreciation. Now, the public is expecting far greater things from the business world, and that puts pressure on financial centers. There's no doubt about that, because we ultimately are expected to do that as well, to deliver those results, but also to drive capital to other businesses who then deliver results there. So I think it's an interesting point in time where we have to step up as leaders in the business world, leaders in the financial community, and deliver results on very difficult problems. So to my mind, that certainly is going to take collaboration. There's no doubt about that, to deal with these big, thorny issues. Climate is one that faces all of us, of course. The social issues can be very different from country to country, but at the end of the day, I think we're going to learn from each other on that. And I'd like just to, no one will be surprised that I'm going to talk about one particular element of leadership, which I think is important. Manal mentioned at the beginning in my introduction that I've moved from being the CEO of Toronto Finance International and representing Canada's financial services sector to a role with Women Corporate Director Foundation. And that organization is focused obviously on women in leadership and the importance of women in leadership in the economy. And so I put it to all of you to think about, what does the face of leadership look like? The public is now looking for us to make progress on these issues, the social issues, the climate issues. And if you look at the face of leadership, if we just take CEOs as one measure of what is the face of leadership, only about 5% of CEOs globally are women. So I think we need to think about that. We know that having better diversity in leadership drives better results. I won't take you through all the studies, but there's many, from McKinsey to Credit Suisse to many, many others. So I would argue that if we're going to make progress on these big issues, we need to think about leadership. We need to think about talent. And do we have the right people in the right seats? And I think that if we don't use the female talent pool for leadership in the economy and leadership on many of these issues, I don't think we'll get there. So I put that challenge out to you among the many others that we're talking about today, because I do think it's a very, very important piece of the puzzle. I think talent is going to be a huge component, diversity and talent, but also, as Miles, I think, touched upon, do we have the skill sets out there? It's a very, very important piece of making progress and achieving the results that we want today. So with that, just delighted to be here today. It's been really interesting to sit in on the meetings. I'm so pleased to see the level of engagement in these discussions. The number of countries around the table, I think, is fantastic. I do think we've got some great people here who are looking to drive change, some great leaders who can make progress on many, many of the issues that were touched upon in the earlier panel, and those I'm sure that we'll discuss in the subsequent panels today. So again, thank you for the opportunity, to CFC for hosting. Thank you for the opportunity to be here today. And it certainly has been a privilege, I will say, to be the chair of YFC and the co-chair of FC4S over the last 2 years. Thank you very much.
Thank you very much, Jennifer. We appreciate you, we appreciate your leadership, and we once again want to wish you all the best in your new endeavors. So, ladies and gentlemen, we will invite you for a quick break of 10 minutes just across the doors right there. So we will reconvene back at 10:40. The next conversation is one you don't want to miss, so please be back in the room in 10 minutes. Thank you. Thank you. I think we can now close the doors and move on with our program. Many exciting things still waiting for us. So for the second dialogue of today, the second dialogue we're about to listen, we will explore options and experiences for greening the financial industry. From COP26 to COP27, what are the opportunities, the challenges, and what are the solutions? And for that, I'd like you to join me in welcoming the moderator and the Africa editor of the Financial Times, Mr. David Pilling. Please give him a round of applause. Welcome.
Is this on? Can you hear me okay? Yeah. So my name's David Pilling. I'm the Africa editor of the Financial Times. That's a scary sight behind me there. I'm from the FT, not from The Economist, so our style is different. I'm sitting down, I'm sitting in the middle. I hope you're taking note of the differences between our publications. So we have a challenge on this panel. I really want to take things forward and build on, you know, in a sense, what the sort of mile-high view we got from the first panel. Fortunately, I'm helped very much by the title of this one. So the title is From COP26 to COP27, Challenges and Solutions. There's a subtitle, The African Perspective. We will talk a lot about Africa, but not exclusively. We'll also be talking with examples from Kazakhstan. We'll be looking obviously at Morocco, which is clearly a part of Africa, but also, you know, there are some obvious differences. Now, from COP26 to COP27, a lot has happened in a year. I mean, if you've been following politics in the UK, you'll know a lot can happen in 24 hours. But, you know, COP26, a lot of pledges were made. There was a kind of coming together, a consensus being built. A lot of that has been, let's say, postponed. I wouldn't say shattered, but certainly things have changed with the Russia's invasion of Ukraine and the energy crisis that has triggered. There's this feeling in Europe that, you know, that Europe wants to be virtuous in terms of climate change, but not yet. And you've seen, you know, Germany talking about reopening coal-fired power stations, the president of Botswana talking about constant delegations of Europeans trying to buy coal from Botswana. You've had the Polish Prime Minister in Nigeria trying to get some LNG things have changed. The taxonomy in Europe has changed, and now gas is suddenly a transition fuel. From the African perspective, they have kind of been crying hypocrisy here. You know, you're telling us that we have to, we have to think very carefully about net zero and about transitioning to green energy, and look at you in Europe. You have multilateral institutions, for example, the European Investment Bank, that will not fund any projects that have anything to do with fossil fuels. And yet there you are. So this is, I think this is going to become very much a theme of COP27, and you will hear talk of a just transition, of the hypocrisy of the North as seen from some of the South, maybe much of the South. People will be asking, where is this $100 billion climate fund that we've heard so much about? This is meant to be an annual fund, and we haven't really seen it come together at all, and we'll be talking about that, I know, in this panel. Something we may not talk about in great detail, but I think is worth flagging just now, is the $8.5 billion, it was called the JETP, the Just Energy Transition Partnership for South Africa. This was the North making $8.5 billion available, at least in theory, to help South Africa transition from coal. So the question is, what has happened to that? And the answer is, it's kind of run into politics. It's run into politics on the ground in South Africa, and to some extent internationally, but I think mainly in South Africa. And of course now in Sharm el-Sheikh, we're going to see the first COP on African soil since COP22 in Marrakesh. So a very important milestone, and I'm sure we will be talking about Marrakesh to some extent. Let me invite the panel up. You've heard enough from me, at least for the moment. So our panel of experts, first of all, Stephen Nolan, Managing Director of the UNDP at FC4S. Gilles Weiss, please come up. Gilles Weiss, CEO of Infraco Africa and member of the Executive Committee of PIDG, that's the Private Investment Development Group. We have Aygul Kusalieva, Managing Director of the Astana Financial Center, who's head of the Green Financial Center. And last but not least, Ayman Cherkoui, who is the director of the Hassan II International Center for Environmental Training. Thank you very much to you all. Let me start with Gilles. From the perspective of Africa, what does a transition even mean? I mean, just a few statistics. The average carbon emissions per capita in Africa is about 0.7 tons. It goes down a lot if you subtract South Africa, Egypt, and a few other countries, but 0.7 tons. But that compares with a global average of 4.8 tons, with the US 16 tons. You know, some of these figures are, you know, that you might read slightly different figures, but those are ballpark numbers. A country like Uganda, 0.1 tons. What does a transition even mean? Transition from what and to what? Or are we really talking about adding power and the kind of power that we're adding? How do you see just a definition, or what is a transition in that context?
Well, thanks. That's a broad question, and I'll do my best. I think you know, energy underpins economic development. So definitely, it starts with energy and transforming the energy matrix, if you will, to a more renewable energy mix. The good news is that the technology exists to replace you know, fossil fuel generation with wind, solar, hydro. There's already a lot of hydro, obviously, in the African countries, especially in the equatorial band and in you know, West Africa. So definitely it means transitioning to renewable energy power generation, but significantly increasing the installed capacity. As you mentioned, the per capita use of energy is extremely low. I think, broadly speaking, sub-Saharan Africa has an electrical system the size of a large Western European country, so 50 gigawatts, give or take a few. That is obviously not sufficient to power an economic development based on more industrialization and more comfort and more facilities to people. So it's definitely changing the fuel mix and very, very significantly increasing power generation, very significantly. I would say then the second one is industry. We live in, well, we're in a country right now, which is Morocco, which has a very, very dynamic industrial sector, manufacturing sector, high-end manufacturing, creating a lot of jobs, creating a lot of foreign exchange, creating a lot of value, and industry, high-quality industry is the basis for prosperity. So how do you get a sort of industrial development that is not based on extractive industries, the classical extractive mines and let's say oil and gas, but capturing the value, keeping it in the country, creating more jobs, creating ecosystems. And so for me, the transition really, it's centered around the energy systems and dynamic and modern forms of industry.
So just to push you a little bit on that, for example, I was with Dangote in Nigeria recently. They said, we need gas. We want to make cement. I mean, Dangote is obviously a huge cement maker. We don't know how to make cement without gas, and you're telling us we can't have gas. Just to add to that, you talked about hydro, and of course hydro can be a base load. It's non-intermittent. Wind and solar, the problems are they are intermittent, and the battery technology is not yet there, certainly in terms of cost-effective battery technology. Some countries are blessed. Kenya has geothermal, that can be a base load, but others are not. What are they meant to do if they don't have hydro, if they don't have geothermal? Where is their baseload meant to come from? So that's two questions really. And they both point at, do we not need fossil fuels for the moment?
Yeah, so you're putting me in a little bit of a tricky situation. So personally, and in my past career, I spent 20 years working for an energy major, which included Gaz de France. So I started my career in downstream gas, and I have seen the potential of natural gas, of course, to optimize economies. Now I am in the development finance space, and my organization is funded by governments who sometimes have a slightly, north-centric view, shall we say, on the whole matter of gas. What I will say, from my personal perspective is, and I talked about renewable energy a few minutes ago. Renewable energy has really transformed the power generation sector. And I think it's the shining star of the energy transition. It's what the West, and now increasingly the world, has been able to do with renewable energy. It's a phenomenal change. It's the biggest news, I think, in energy transition. So you can do a lot with renewable energy. Then there is the question of gas-fired power generation. It emits CO2, but it's obviously the least emitting form of power generation. I personally think there is place for gas-fired power generation. I don't want to dwell too much on that because it's controversial. What I would like to say is that industry and running industrial processes where you need heat, where you need well, heat basically. It's a shame not to run industrial processes on natural gas and to use coal or heavy fuel. So I do believe there is a space for natural gas, definitely in industry, and on a personal level, I think natural gas will have its space in the energy transition.
Thank you very much. Sorry to put you on the spot there, but I think it is an important issue, and it's one that will come up very strongly at COP27. If I could ask you, Igor, how does that look from Kazakhstan? I mean, you have quite a lot of coal in your energy mix, but you're also moving, quite strongly, in a green direction. How does this transition look from Kazakhstan, and how do you see that as reflecting on broader issues, whether it be in Africa or, in other geographies?
Thank you for the question, and I was, like learning, listening to the conversation here about the gas, because that's the question we always have in Kazakhstan as well. Because overall, the country is just like any other emerging economy. Let's say, for instance, like Nigeria in Africa, is heavily depending on fossil fuels in its economy, and let's say like around maybe 60 or maybe even 70% of our GDP comes from extractive industries, including mining, fossil fuels, as I said, and including gas. So, and we're working on our national taxonomy and green taxonomy for a couple of years. The thing is, we always had this question, shall we include gas or not? And, in this question, I like this approach Biden had during early COVID times, when he said that we will follow the guidelines of science. So when they say this is right time, let's say, to take off the masks, we will do so. So the thing for us, we listened to our scientists in Kazakhstan, and we looked at the international experience. And the thing is, when we were working on the taxonomy itself, we also had to keep in mind that we are working with a potential standard for the companies who will be coming from abroad, to do the business in Kazakhstan, including those from the European Union, let's say, or China. And we looked at the experience of the European Union at that time, which didn't have gas. And we had a lot of conversations, but the thing is, in the end, we didn't include the gas as green in our taxonomy. But I need to admit that currently, when we have these talks on the carbon neutrality of Kazakhstan by 2060, which is a plan for us, we're looking at gas as, the transition fuel, just said like a few minutes ago. It's the way to use this maybe as a way to sort of, help this transition for some time. And currently we see that gas can be considered as a transition energy source until 2035. 2035, exactly. Okay. That's the point of view here.
Okay. As you brought up taxonomy, I wasn't going to bring it up so early. This is something that came up in the previous panel. Why does Kazakhstan need its own taxonomy, and how does that fit in with taxonomies elsewhere? Let's say the European one. Are they interoperable? I think was the phrase that was used. I mean, many people here will know exactly what taxonomies are, but just for the help of those who don't, can you just explain what a taxonomy is? What are we talking about here?
Right. So I like the discussion, which was here just during this previous conversation. So I like the point about clarity. Because the market needs clarity, and we do need to avoid the greenwashing. So when the investor is coming to invest his money, he wants to know that it's going exactly to the type of project he wanted it to be invested, And that's what we were keeping in mind in Kazakhstan when we were working on this taxonomy. Another thing is having this, let's say, national interest to be taken into account, because any country is sort of different in its economic development, let's say, and different industries in its economy, and it should highlight those which really need the investment, and they should sort of tell the investors that we would welcome if you invest in these sectors, and these are green. And I just said now that we kept in mind the foreign investors who will be coming to Kazakhstan, and we did make sure that our taxonomy is in line with the European one, it's in line with the Chinese one, and it's very interesting actually that the first green bond which we had in Kazakhstan, it was issued against international standards, so ICMA and the Climate Bonds Initiative. At that time we did not have taxonomy, but then the first bond actually indeed helped us, to have this conversation with our government entities it helped us, to sort of have this conversation going with investors and work on the taxonomy to have the final document, approved by the government. And back to your question, what is taxonomy exactly? So sort of, let's say, a classification of activities which you consider sustainable or green or social, depending on what type of taxonomy you are doing, right? And then it's a type of projects with certain thresholds. Of course, for renewables, let's say like solar, usually there are no thresholds because it's like by default green, right? But then like certain type of projects, just like hydropower, for instance, they do require thresholds, and mostly it's all about reducing emissions, of course.
Yes, you say by default green, but of course everything has a hidden, I mean, even batteries, where does the ingredients for the batteries come from, under what conditions, etc. But maybe that's taking this conversation a little too far. Ayman, if I could bring you in, because what we're talking about here, in a sense, is defining the rules of the road. Following science, but also defining rules that are in line with the political requirements and national requirements, international requirements, and of course the overall goal of transitioning to an energy base that is not going to drive the planet into an existential crisis. I mean, that's what we're talking about. Your organization is very much involved in training in the technicalities of this. So how do those technicalities fit in with these broader questions which lie really at the root of this conversation?
Well, thank you very much for this question. Of course, I want to express my gratitude to the CFC for the invitation and having facilitated this very fascinating conversation. Earlier, you were joking about the current news cycle context, but I want to commend you because in spite of this current news cycle context, you still found a space to publish this morning on climate change in Africa. And specifically, you were arguing why you felt that Africa should be central in the context of what you refer to as the climate change conundrum. Yeah. And the reason why I'm referring to that is because the title of the session is from COP26 to COP27, evidently. And in COP26, His Majesty the King Mohammed VI, may God assist him, in his royal message indicated that given the climate damage that is inflicted on Africa, the weak financing, the insufficient technological support, in the most flagrant way, are indicators of the inadequacy of the international system that is currently in place. Yes. So in this particular context, to answer more specifically your question, I think it's important to have in mind, as we were discussing in the previous panel, these three elements of the global, the regional, and the national. And we engage in training and capacity building across these levels. Training and capacity buildings across different stakeholders, for example, looking at local authorities. We work in close collaboration with the Interior Ministry in Morocco to train local decision makers in terms of how to build what is called bankable projects. And I have issue with this particular term, happy to discuss it later. But also work with young entrepreneurs, African entrepreneurs all across the continent in terms of the projects.
Okay, great. And we will talk about bankable projects, so thank you so much. Stephen, if I can bring you in. We're going to talk about private finance flows, but of course there aren't only private financial flows, there are public ones as well. There's been a lot of talk about this $100 billion that's been promised, but hasn't materialized. Again, this is going to come up, I think, quite strongly. This talk, I think it's now called the Loss and Damage Fund, but anyway, there's lots of different ways of referring to this money. But I think the one thing in common is that, at least from the perspective of the Global South, it has not yet appeared. What is going on, and what is I guess the deeper question is, what is the role of public finance in catalyzing private finance and giving it comfort?
Thank you, David. Before I get going, if I may just take a moment to thank Casablanca Finance City Authority for having the United Nations Development Programme Financial Centres for Sustainability here this week. I want to compliment the vision of Lamia. She brought, and her colleague Saeed brought us together with the WFC, and I think today's Casablanca Sustainable Finance Dialogue, we hope, will become an annual event. So just thank you very much to Lamia. And for our colleagues, Busha and the team, for bringing us all together. So into the question, You know, we all know that no one government, the US, China, can actually finance on their own national decarbonisation efforts. And so we really need to see at scale private capital crowded in, and this is what Gilles and other colleagues do. But I think a commitment was made and the commitment has not been delivered upon. So, you know, everybody's got every right to be furious about that. And the commitment has been talked about for quite a long time now. And even if we look at the context of 100 billion, look at inflation right now, it's, you know, so it's not still the same amount. And we know that that 100 billion is just a drop in the ocean. So hopefully over the next coming days, in advance of COP27, we will see something more concrete come out about that. However, David, if I can now pivot, if that doesn't happen, we need to be relying more on the private sector. And I know capital from the public sector is very important, but it's also that regulatory and policy environment that the governments can actually create as well to entice the capital to be invested where it needs to be invested. And that's why it's great today to see the Central Bank of Morocco and the regulators also here with us today in the room, because they are important cogs in this wheel as well. So if you then take a pivot beyond the 100 billion into, well, what were we discussing here yesterday as the FC4S network, and a group of financial centres that actually this is where the capital exists. And you know, what was quite interesting among the different groups we had in the room between North and South is that in the main the challenges are similar. They're similar in Frankfurt as they are in Lagos in trying to overcome some of these challenges, and we need a major uplift at a financial centre level in mainstream and sustainable finance at a more accelerated level. We need, you know, to focus on tools. You mentioned taxonomies there earlier on. I'm delighted to see Eamon, a great Irish name, at the bottom of the panel as well there. But on the capacity building side, we need to speed that up in a dramatic fashion. And I think that term, a major uplift, is what really came out of our FC4S meeting yesterday, our strategic retreat, and how can we accelerate that? Because at the end of the day, Eamon, David, in moving forward into COP next week, it's going to be quite exciting what's happening. There's going to be a lot of talks. The 100 billion may or may not materialise in terms of the full amount. The private sector will be there in force. We need to scale up in terms of the private sector are doing. And while COP27 is important, I think COP28 next year is critically important in the UAE. And it's delighted to see Philippe here from the UAE in terms of the sovereign funds and what UAE are able to bring to that. So we are looking from Glasgow into COP28 as a 24-month process. And as I said, within the financial centres, that major uplift is going to be key to that 100 billion if not going to happen.
Okay, let me push you on the 100 billion, because there is talk that the whole way that this is conceived is kind of wrong. I mean, if you have a big pool of money, 100 billion, well, who gets it? And people are saying that actually it might be much better to organize this fund in the way that, for example, the JETP with South Africa has been organized. So you have various countries on one side, they're big ones in terms of the JETP, it's the US, the EU, France, Germany, Britain, and South Africa are on the other. And you know, that doesn't mean that it's not complex. It's indeed extraordinarily complex. I'm going to be writing about this next week, but it's possibly less complex than having a 100 billion pot of money and saying, you know, who gets it for what, when, why, who. Are we going to see more JETP style financing packages of north to south, which again is meant to catalyze, isn't it? I mean, that 8.5 billion is only a small portion of what's needed. It's meant to catalyze the private sector.
I think what you're going to see is the answer is yes, because you're going to see other countries wanting to move at speed, and they're going to say we can do a deal directly, like what you've outlined. The second one coming out of the G20 Indonesian presidency this year, my colleagues oversee the Sustainable Finance Working Group there, is the multilateral development banks. Those will already provide capital, and we saw this a few weeks ago. There was quite a mini scandal with the World Bank president and his beliefs around climate or not, and is the World Bank actually investing enough money in this space? So I think what we're really now coming to a point, David, is there's frustration on the 100 billion. Is it going to happen or not? So whether that frustration is new forms of, we'll do it directly with you, consortium to a country, or B, we'll look at the multilateral development banks and existing funding pots and say, we need to get more climate-aligned investments within that.
Okay. Gilles, I think now we do need to talk about the role of private sector finance. You know, I mean, the question, what is its role, is probably far too open. I guess what unlocks it? Is it, you know, the DFIs? Is it a kind of a blended finance type scheme where some of the risk is taken out? How do you see you know, we've heard in the first panel about the funding gaps, huge funding gaps. How do we really make this step change in terms of unlocking private finance?
So, you know, I want to talk carefully about public versus private finance. You know, I grew up in a country, in a region where until, you know, the 90s, all of our critical infrastructure was provided by the public sector. We are in a country, Morocco, where the public sector is doing a great job of electricity access universally, water, sanitation. So there are, you know, the public sector is a very important and, you know, continues to be the largest provider. I think, if you look at the statistics of funding for critical infrastructure. That being said, you know, we've got a perfect storm, if you will, happening, and I'm speaking specifically of you know, more sub-Saharan Africa. We've got governments whose financial capacity is stretched to the limits, and you know, they are not going to be able to deal with the challenges. Let's just take one: the 600 million people who don't have electricity access. You know, the public monopolies of electricity, they're not going to be able to solve that problem in the next generation. And if they don't solve it in the next generation, we've got ourselves a huge problem. So the limits of the public sector are there. There's a failure. Let's just take the case of energy access, and that's where you see you know, very interesting concepts and paradigms coming in from, you know, what I would call very hardy entrepreneurs, very you know, very gritty private sector. If I mention again the sector of energy access, you're starting to see more and more in sub-Saharan African countries, which have, let's say, 30% electrification, 5% rural electrification. You're starting to see business models around mini grids and decentralized energy access. There's a lot of technology involved. There's a lot of operational excellence involved. There's a lot of financial engineering involved. It's all very complex. It's all very promising, and it is being driven, if you will, by private sector brains, if you will. Now, it's the work of development, the work of actually getting infrastructure developed in the face of legal, regulatory, technical, political challenges is huge. And those entrepreneurs who are trying to solve these big problems, they need help, specifically financial help. And so that's where blended finance comes in, because you know, these entrepreneurs, they're not doing this out of charity. They want to make a return. They want to make, you know, 15% IRRs. They want to make 20% IRRs because they're taking huge risks. And right now, the economics of a lot of these infrastructures, they don't stack up. They don't stack up. They are going to stack up in maybe 10 years or 5 years, but in the meantime, they're going to need help. And I think that the leveraging effect of blended finance, you know, used strategically, can do tremendous acceleration, if you will. So blended finance really has a very important role. It should be used strategically, and it's not. I always like to say it's not that much money in the grand scheme of things. You know, developing a large infrastructure project typically requires about 5 to 10% of that project's cost to develop it. That's the hardest money for entrepreneurs to raise. It's the riskiest money. And so, you know, getting blended finance, getting concessional money into early stage risk, early stage development, from my perspective, that's where you get the biggest leverage, and that's how we're going to address, you know, the sort of the billions to trillions problem. Because if you don't have pipeline, if you don't have projects, all that money that people want to, you know, disperse, if you will, on bankable infrastructure, it's never going to happen. So we need to start from the bottom up.
You've put your finger on several really important issues there. I mean, you know, public governments, they invest in public goods, which are not necessarily profitable. And the problem with purely private finance is that it only goes for profitable projects, which might not mean a rural village with a distributed solar power system. You've obviously got the politics of what you can charge for energy and whether you can charge above the production cost. Something else I think very important that we'll come back to that you mentioned is the falling capacity of many governments. I mean, I know Africa now better than other regions, but for example, I sat down with Kristalina Georgieva, the managing director of the IMF, at our Africa conference on Tuesday. She was saying that 19 African economies are now in debt distress, you know, or on the verge of debt distress. I don't want to misquote her, but she mentioned 19 countries. Clearly, those are not countries that are going to be splashing out on big projects. Eamon, if I could turn to you, because this term bankable project has come up, and we've sort of raised it. Private investors need to make a return. They may be helped by DFIs or some blended finance element, but still they need to make a return. You said you didn't like this term, blended bankable project. Well, why not?
I'm not particularly fond of this term for a series of reasons. First, well, actually, I'll frame it based on the comment on transition that we heard previously, sharing an African perspective on transition and the position of the African group of negotiator when it comes to that. From their perspective, it is not about the transition, it is about just transitions in the plural. And these two elements of justice and transitions in the plural, I think, are very important to keep in mind, specifically given the historical responsibility of certain emitters when it comes to the climate change crisis. The reason why I'm not particularly fond of bankable, the term bankable, is because I find that it displaces the responsibility to a certain extent in terms of the lack of actual climate finance having flown towards the global south, towards the recipient and the people that should be accessing this finance. So whenever I hear, the reason why there's not enough climate finance flowing your way is because we do not have enough bankable projects to invest in. I find that first, it is about the criteria that are being used. We talked previously about the technical elements of this, how to define something that is bankable, and also rather than bankable, I prefer investable, personally, rather than bankable, because I think that, I find it to make more sense. And also, you were touching upon a very important point from the African perspective, again, when it comes to the example you provided, which is, we're talking about climate finance in general, but there is mitigation and adaptation. And adaptation is a critical priority for Africa. Unfortunately, there is profoundly, the gap when it comes to adaptation finance is simply humongous. And when you combine that with the narrative of bankable projects, and that's why I revert back to your example, we turn into a deepening of the profound injustice that is inflicted on Africa.
It's not clear how an adaptive investment is necessarily a profitable one. I mean, if you build a wall to stop the sea coming, it doesn't make you any money. It's insurance, basically.
Well, it depends on the time frame as well, right? Because if you are looking at a time frame of a couple of years, 3 years, 4 years, 5 years, then it doesn't, yeah, there are some challenges to that. But if the time frame is longer, when you have more, for example, there was a lot of hope at the time for investors that have a longer time frame for them to engage more deeply in adaptation, pension funds and these kind of stakeholders. It has yet to happen at scale, but it's also an issue of time frame for looking at the return on investment.
Let me just ask you about the Moroccan experience in developing capital markets, because you have, you fund projects here with dirham. You don't rely on dollar markets and the currency risk that comes with that. Of course, much of sub-Saharan Africa, everything is funded in dollars or in hard currency. And now with the reversal of interest rates and the reversal of capital flows, this could lead to profound crisis. What was yesterday a bankable or an investable project may suddenly find itself not so much. Can you tell us about the experience? And of course, there are some examples in Africa. There's the PIC, the big South African pension fund. There's the AFC, the Nigerian Development Bank. There's Afrexim Bank. There are examples, but they tend to be these sort of shining lights and they're the exceptions, not the rule. What was Morocco's experience? And I'm going to ask you about Kazakhstan's experience as well.
I'll be very brief on that, but basically, of course, it's important to place it in the context of the vision of His Majesty the King and the ambition and the prioritization that's been given when it comes to climate change action and ambition. And in that context, of course, again, in the royal message of His Majesty the King in COP26, he also indicated enhanced ambition when it comes to the reductions of greenhouse gas emissions. And the NDC that's been updated was already previously ranked as one of the most ambitious in the world, so even more so in that particular context. When it comes to that experience, again, to use the framing of the national and the regional and the global level, this experience has been connected to those two elements. When it comes to, for example, I think yesterday many of you connected with the event where the president of the Moroccan Authority on Capital Markets spoke. And in the context of COP22, which you also referred to, there was the launch of an initiative which is called the Marrakesh Pledge to Foster Green Capital Markets in Africa. So also there was the sense of we cannot do it alone. It was important to have this element of coordination. Specifically in the context of Morocco, it was done through, we have, as you indicated, and you're very knowledgeable about this particular aspect, and others, I'm sure. It's the sense of, well, we have green bonds that's been launched. We also have, of course, ESG framework in the last few years that have been strengthened. In terms, we also have connected with the important work on the task force on climate-related financial disclosures. So all these components are coalesce into an approach that is coherent, that is also built on a cooperation of stakeholders, and that includes the Moroccan private sector when it comes to the employers' organization, for example, the Ministry of Industry and Trade, the Ministry of Energy Transition and Sustainable Development. So I think this particular experience is really very much one that's been built on consensus building, on a national approach that also includes the infranational stakeholders.
Okay, can I ask you about the Kazakh experience here?
Yeah, this is actually the conversation regarding $100 billion. I'm loving this, you know. The thing is, in Kazakhstan, when we're working on this strategy of carbon neutrality I mentioned earlier, we were also looking at these, let's say, like initial estimates, and the number was $600 billion until 2060 to fund this transition for Kazakhstan. And we also had this question, who is going to fund this and where this money is coming from, right? And it's almost like private-public blended finance and things like that. And the thing is, you know, I think it's not only about, you know, working on direct, like, let's say, like funding of the projects, but it's also working on the ground on the institutional framework, you know, infrastructure, and the policies which will allow to channel this funding, you know, to climate projects. And that's where we can step in as a financial center in Astana. In fact, I believe that AIFC is quite an infrastructure, you know, it's like excellent place to channel the funding because we do provide certain tax incentives, you know, for participants. And our center in particular, we're working a lot on the policies, you know. So we did work on the green bond rules, and I mentioned the taxonomy, and we also put a lot of efforts on the subsidy scheme with the government, you know, for the, you didn't like this bankable projects term, but let's be honest, for bankable green projects, right? And also, even though our mandate is develop the capital market, so we're like putting all these efforts on the capital markets, we do understand that, in fact, in many emerging economies, and I believe it's true for Africa as well, let's say most of the funding is coming from banking sector. For Kazakhstan, it's around 70%. So we need to think about banking sector as well, and therefore we did do some work on supporting our own regulator in developing the guidelines for second-tier banks and developing certain guidelines, I would say. And maybe it's not a news for some of participants here, but for those who are new, let's say, to the industry, Green Climate Fund is like quite a good, I would say, vehicle, you know, to sort of help the emerging economies to mobilize funding. Because in our case, for instance, we did apply for this readiness funding to support the national regulator in developing this institutional framework, you know, for channeling climate funding. And the thing is, yeah, we got approved, I mean, we approved our proposal, and we're planning to work on this with our regulator in coming couple of years. But I think like that's like the way, you know, sort of handling this, you know, using different, let's say, instruments.
Yes. Let me push a little bit on verification, because, you know, the idea of greenwashing came up earlier. You know, you're linking investors who want sustainable, quote-unquote, projects. There's a sustainable project as kind of verified by us and our rules and our taxonomy, etc. So a couple of questions come there. I mean, in overly simplistic terms, let's talk about trees. You plant a tree, how do you know it's going to stay there? How do you know that this project is not only sustainable this year and next year, but going into the future? That's the first. Second, there is this question about additionality, which I don't know how many people I'm sure many in the audience are aware of this discussion, but the sustainable finance is always looking for additionality. This is a big problem to some extent because, for example, the forests of Gabon, which are, is an enormous carbon sink, which is sucking up carbon. There's no additionality there. The problem is that if somehow that isn't financed, somebody's going to chop it down. The way of making money out of those trees is to chop them down and turn them into furniture eventually. How does a government like Gabon get money without additionality? And is that something that your taxonomy, your sort of verification schemes take into account?
I would like sort of maybe divide this into two topics because
they are two topics.
Because when we talk about carbon credits, that's what you were talking about, the additionality. It's a bit different thing because in Kazakhstan we do have this emission trading scheme. Mm-hmm. So basically it's a cap and trade. The companies which have this certain amount of emissions, they do need to reduce the emissions, and if they're going above, you need to go to the market and buy these carbon credits, right? And then there is like a certain type of verification, as you said, for those projects which are going as offsets. For these companies. So we're working on this in Kazakhstan, but the thing is, like, it still didn't, let's say, like, it's still not that big, I would say, and the main issue the main issue is that it's at early stage of development in Kazakhstan, and the thing is, the government is still providing a lot of carbon credits for free. So it's not sort of, incentivizing the market to work. So that's why I cannot go deep into the details because there's nothing much to sort of report. But if we talk about the green bond, it's a bit different type of the verification because we do verification ourselves as a center. We do provide this second party opinion for the issuers of green and sustainable bonds. And the thing is, initially when the issuer is working on the project and before it goes to the bank, let's say, or the potential investor saying this is the green projects, please, we need to sort of have a conversation, right? They do have this initial conversation with us, for instance, or any other institution providing this second party opinion that the project is green and it's in line with, let's say, national or international taxonomies. Yep. And that's the way of doing that, you do it at the initial stage, and usually the best practice is do it annually. But some of the projects, they do it after 1 year, and then they just keep going it until the bond is repaid, right?
I see, okay. A couple more questions from me, and then I will open it up to the audience. We heard from Oscar that his one wish, it was always 3 wishes as far as I knew, but anyway, he got 1 wish, and he wished for a robust carbon price compliance market. Would that solve a lot of these problems?
It's one of the instruments, but I do think if you look at the carbon markets right now, you mentioned the term greenwashing. I think we could use stronger terms in terms of the carbon markets. At the moment, a lot of it voluntary, but fundamentally it's come back to your point, David, compliance. And I think we heard from Jennifer Reynolds earlier on, she talked about she used the word trust. And if we really do want to see a step change in this now, we're talking about verification, it's maybe just a different word, you need to trust what have those credits been actually set against. And back to your point, if it's against forestry, that the forest is actually going to stay there and it's not disappearing bit by bit. So I think the step change in the carbon markets has to be around the verification, the compliance within, and if that can be nailed, well then that will be a game changer in terms of unlocking capital. But we're still a bit away from that. I actually think if I can jump onto a different topic is look at biodiversity credits or nature-related credits. So it's almost, this is a topic that's really come up the pipe, Dave, in the last few years, biodiversity finance. I think what we're seeing there is that sector is now learning from the challenges within the carbon markets and saying, actually, we need to get the governance right first before we begin to issue credits. And so that's kind of a difference there at the moment. But I think, David, if we can get the compliance and the governance right, yes. However, we saw Carney really bring this to the fore last year in COP26. And the discussions have kind of disappeared. It's not as loud anymore as it was this time last year. So there are challenges, but there are some very good people working on trying to sort those challenges out.
Okay, Gilles, I want to change the subject and ask you about green hydrogen. You know, is green hydrogen a fantasy in Africa, or is it real? You know, you have countries like Namibia, South Africa, Morocco, I think, Algeria, talking very, you know, very loudly. They can be green hydrogen superpowers. Can they be? Are they going to get financing for this?
So honestly, that's a difficult question. I want to go back. I want to go back first to the. You asked me a question at the beginning about what does a transition look like, and I talked about energy and industry, and I talked about, you know, a just or a rich, let's say, industrial system that creates value and employment. Now, the problem with industry is it emits CO2, and if you need to, you know, create very, very, very large and powerful industry, you need to consume a lot of energy. You know, if you think about producing steel, producing bricks, producing cars, producing plastics and all sorts of, that's all very energy intensive. So the challenge with the energy transition is also decarbonizing industry, and that's, I think, where, you know, the strategists are thinking, how can I decarbonize the large industrial processes? And that's where hydrogen comes in. So yes, I'm a little bit on the fence. As I told you, a good part of my career I was in the natural gas industry. The networks exist, the infrastructure is there. Creating a whole new sort of hydrogen system is going to be very, very challenging and very expensive. But it is something that we should be looking at, you know, seriously. And the question is, you know, does Africa produce hydrogen to pipe it up north? Or does Africa produce hydrogen to use it for its own industrial transition? I get a little uncomfortable when I hear about all the super majors who are thinking, hey, let's do big hydrogen projects in North Africa and ship hydrogen to Europe, because that solves the problems of Europe, but I just wonder what about the problems of Africa's industrial transition. So I think we should consider that it is something very, very interesting, but we should be cautious.
Okay, I think that's very interesting. There's lots to chew on there, but I would like to. I mean, I may go back to it, but let's open it to the audience. Let's go there. Question here. I'm going to take one question at a time. I've remembered you, so we'll come back to you.
I would like first to thank the panelists for bringing the African perspective to the table. We are in Africa actually facing a double inequality when it comes to dealing with climate change impacts. We are mostly relevant, but also mostly vulnerable, but also we have less capacity to deal with and recover from climate-related disasters. So my question here is, what potential do you see for international taxonomies that are a necessary precondition to ensure a stable foundation for climate or transition financing, to also include this climate resilience and adaptation component to make sure the transition is actually fair, just, and inclusive?
Yes.
I think it is critical when defining sustainable activities to also take into consideration African-specific needs. This will help advanced countries better deliver on the $100 commitment and better serve adaptation and improve the business case for adaptation projects in Africa.
Okay, who would like to take that? I mean, Eamon had a go at that before, but is there anything you'd like to add? And please, anybody else?
Thank you. Excellent question. And I wanted to react on 2 points. First, we heard about trust in the special message before. It was already mentioned here, but the 100 billion is also a signal of trust in the process, because promises were made, pledges were made. So it's not just about the fact that it is not up to scale compared to the scale of the challenges, but there's also an important trust signal that I wanted to, because there were different layers to your question, so I wanted to react to that one. When it comes to to taxonomy and also connecting to what was said previously on the risk of greenwashing, for example, wanted to mention two things. First, that the UN is doing a lot of work in that context. Within the space of UNFCCC, there is, for the Race to Zero, that some of you might be familiar with, there is an expert peer review group, which is co-chaired by my good friend Thomas Hill at the University of Oxford, that is looking at criteria, that has established criteria to avoid the risk of greenwashing. And the second one, at the broader UN level, the former Environment Minister of Canada, Catherine McKenna, was nominated earlier this year by Guterres to chair a high-level expert group on net zero commitment. So evidently, when it comes to adaptation and resilience within the context of Africa, it starts by particularly high emitters keeping the pledges and commitments and avoiding greenwashing. Now, I don't want to be too long, but happy to discuss one-on-one on other points you raised. Thank you.
Okay, great. I'll leave it there. There's a question here and then a question there. Let's take this one. Yeah, could we get the mic to this table? Thank you very much.
Hi, I'm Keiichi Aitomo from Tokyo.
Okay.
I'm also assuming leadership role of YFC from Jennifer as a chair, together with Lamio of CFC, Casablanca Financial Center, as well. It's unconventional to ask questions to moderator David, but
to me, no, very.
Given that your very unique position, experience, being the having the role of Financial Times Tokyo bureau chief.
Oh, I was, yes.
So you
got a long
Tokyo
memory.
and Asia and Africa enough. So two questions. Number one.
Okay.
What can Japan do together with African jurisdictions market to address the green transformation issues from your perspective? That's number one. And second is a little bit more sensitive. It's more like a elephant in the room, right? Nobody talked about the nuclear, although we have a representation from Kazakhstan, which produces where the largest producer of uranium, right? And in fact, Japan is front running the circulation of the nuclear energy fuel, which is almost taboo to talk about because there's a lot of as you mentioned, hypocrisy and also propaganda. Also,
just I want other people to be able to. So, I mean, and I don't want to dominate, but I mean, I think that you are hearing talk about particularly modular nuclear power stations. In South Africa, for example, Praveen Gordon was talking about that precise thing the other day. So I think people are thinking about small-scale nuclear power stations. Probably in, we're not talking about that in Niger, funnily enough, where there is uranium. We're talking about that in some of the more industrialized countries. So I think that that is hoving into view. As you say, it's the elephant in the room, and there is this need for baseload power that's still very real. As to what Japan can do, I mean, clearly, TCAD has been an important phenomenon. It was just held in Tunisia a couple of months ago. I mean, I think, what Japan can do is a couple of things. One is it can acknowledge the difficulties. I mean, Japan has gone through, an extraordinary transformation since the Second World War, and that was built largely on fossil fuels, I mean, and nuclear. So, I mean, Japan knows what it takes to go from being poor, not that it was poor in 1945, but it certainly was in 1880, let's say. It knows what that kind of transition looks like, but it also knows that this kind of a different path is now needed for poor countries today because they can't tread the same fossil fuel path. So what is it that they are being expected to do? And I think kind of grappling with that question head on. The second is what we were talking about really, is to be a catalyst, the blended finance, the de-risking, here's a crazy project that nobody in their right mind would fund, but we're going to fund it. We're going to put the keystone funding and invite private capital and proof of concept. Japan had 11 car makers in I don't know, the late 50s, 1960. People thought that this was crazy. They couldn't even get up the ramps of US highways. 10 years later, they were dominating the car market. Japan has gone through that experience of going from what seems like something that's impossible to something that is possible. And I sometimes think that the ambition is not large enough. I think Japan can push that ambition. That's enough from me. Question here.
Thank you, David. My name is Zaid Bilbaji. I run a advisory business. 80% of the continent's energy is generated currently from non-renewables, give or take. And the transition will be expensive, and governments will miss out on valuable foreign exchange reserve, valuable foreign currency reserves. The money that they generate from government revenue from this. My question to you and to some of the panelists is, will the green transition replace this for energy interests, for governments alike, or are we asking African countries especially to take a pay cut just at a time when they are really needing valuable revenues to lift off? It's a brutally honest question, but one that I wondered because the energy transition is just so expensive.
I mean, really quickly from me, because you really don't want to be hearing from me, but very quickly, I think there are two parts to that. One is if you're talking about like the rents from oil that elites get hold of, then I think you were asking elites to take a pay cut. That's fine by me. Look at, I hate to pick on Nigeria, but look at Nigeria. It's had oil revenue for 50 years, and yet it's got a very poor health service, very poor education service. Like, where did that money go? Why wasn't it reinvested in the human capital? So if you're asking elites to forego the rent from fossil fuels, that's fine by me. If you're asking countries to say, you lot have got to remain poor, we're really sorry, we screwed up the world, but now you can't afford to go through that messy process that we have gone through the last 50, 100, 150 years, then that is absolutely a non-starter. It's absolutely a non-starter. You cannot ask 1.3 billion, soon to be 2.6 billion Africans to remain poor for the main part. Of course, there are many exceptions and nuances there. Absolutely not. It's just a non-starter, and we'll get absolutely nowhere, quite rightly, in my opinion. But you don't want to hear from me. Please, Gilles, Stephen.
Look, I want to present maybe a slightly more optimistic note, and we come back to the role of the private sector. So we're not asking, I think everybody understands that the African governments, although I hate to aggregate the African governments, they're going to be relying on the private sector and on PPP frameworks, ideally, to do the transition of the electrical systems off balance sheet of the government. You hear somebody quoted Adesina's speech earlier this morning. Adesina said also, we need finance, finance, finance. So, if there is a proper private sector driven transition, logically, when we hear about all the potential of Africa, the fact that the population is going to double, the fact that it is increasingly obvious that it is the continent of the future, from any perspective, then that money will flow, and it will not have to be borne by the governments, and it will lead to ultimately lower tariffs because what does a kilowatt hour of heavy fuel oil powered production cost today? 30 cents per kilowatt hour, 40. How much is the benchmark of renewable, of photovoltaic? 8 cents, 10 cents. So, there is a positive outlook to all of this, but it will depend on, catalyzing that private sector investment. And, there's no silver bullet. We've talked about some of the solutions, but, I would see it as something, hopefully, that is optimistic and positive.
I think we're going to have to end it there. gladly, on a positive note, collapsing prices of renewable energy. I think that's a good place to end. Thank you so much for a very, very lively discussion and for excellent questions from the audience. Thank you.
Thank you very much indeed, Ayman, Aygul, Gilles, Stephen, and of course David for a very exciting conversation. People are really engaging with us online, and that's really great to see. So just before we announce the winner of the YFC Young Academic Award and break for lunch, I'd like to welcome on stage for the closing remarks the Deputy General Manager of Casablanca Finance City. She's also the co-chair of the UNDP FC4S and recently elected a Vice President of the World Alliance of International Financial Centers. Please join me in welcoming Mrs. Lamia Marzouki.
Dear FC4S and YFC members, dear partners and friends, we came to the end of 2 days of intensive work. I'd like to thank all the speakers for their valuable contribution today, and also all the attendees, the participants, for these 2 days. I mean, again, this is a first for Africa. We have had 2 AGMs, 2 general assemblies of 2 different networks. And I must say that this time we did less net and more work. Today I'm speaking on behalf of the UNDP FC4S and also on behalf of Casa Finance City Authority, obviously. For those who don't know FC4S, just a short presentation. FC4S is the global network of the of the green financial centers born out of the G7 presidency 5 years ago. It was launched in Casablanca on African grounds with the signing of the Casablanca Declaration. We were at that time 15 financial centers. Today we have more than 40 members, financial centers from all the continents. And the network, Financial Centers for Sustainability Network, represents today more than 80% of global equity markets. So as we already mentioned today, one of the unique assets of a financial center is this cluster effect. I mean, we're not only a network of banks or a network of insurance companies, but the whole ecosystem of several actors, banks, insurance, capital markets, industries, but also authorities, service providers, and so on. And we have been reflecting on how we could leverage this cluster effect during these 2 days. So it's clear that today we're living in very special times where temptations to make short-term choices are really, really strong. But we reaffirmed yesterday during our retreat that we need to stay focused and clear about our goals. I mean, for us, the future of finance can only be sustainable. And more than that, we think that in a few years, no need to talk anymore about mainstreaming green finance. It will become the stream. So yesterday, we tried to shape the next phase of green financial activities, and I must say we raised a lot of challenges that I'd like to share with you today because it's quite summarize the 2 panels of the morning. One, while we have witnessed in recent years the rapid growth in sustainable finance activities, its proportion in total global financing remains low at around 10% in some large economies. It's really, really low. And that probably means that the rest of finance, around 90%, is destroying the planet. So how do we address this misalignment issue? We're still working on that. Second, there is a real concern on the quality of market commitments and pledges, which represent a serious risk of undermining the reputation and functioning of the green and sustainable finance market. As we already heard this morning, ESG is having a challenging time with accusations of greenwash rising by the day. And here we need to set a clear accountability system which hopefully within which there will be consequences for those who do not respect their commitments. The third point is that poor data quality and availability remain a strong barrier. We have heard a lot about transparency, trust. It's clear that we cannot improve something that we cannot measure. And within FC4S, we have put in place what we call the assessment tool, the FC4S assessment program, which is today a global and matched reference. It has, been used as an input for the work of the G20 Sustainable Finance Working Group, the Coalition of Finance Ministers for Climate Action, and so on. And this is, one of the unique assets of the real value proposition of FC4S. There is obviously the issue of talents and leadership, and thank you, Jennifer, for sharing with us this gender and diversity issue, and we have put in place within FC4S a gender working group. And last but not least, there is an opportunity and big interest for innovation, and I think that we have been focusing a lot on traditional finance. So we still need to make room for, this whole new generation of people who think differently. Now, as we are on African grounds, let me say a few words about the continent. On the eve of COP27, there are clearly high expectations from African countries, and we are quite worried about the output of COP27, to say the least. I mean, again, we don't see any progress on these $100 billion, which could maybe, it's not the same amount now, as Stephen said, with inflation and so on. And actually, those funds were directed to more to Asia, and especially to mitigation rather than Africa, and to adaptation, because as it has already been said, there is a crucial need for adaptation in Africa. Furthermore, there is a challenge that we don't often mention. I didn't really see it this morning, which is that we should really take into account specificities, regional specificities, when we consider frameworks and taxonomies, and prepare for the unintended consequences of the convergence of the frameworks. I'm talking about the indirect impact this could have, in particular on developing countries, of course, because what could seem like an easy rule or, an easy framework that could be implemented in a mature economy could end up jeopardizing the development of a less mature one. Don't get me wrong, I'm a fierce advocate of sustainability and a great believer of frameworks. But all I'm saying is that there needs to be a larger framework that enables some further flexibility for developing countries that do need it. Because we cannot impose the same constraints without adapting them again to regional specificities and also working on capacity building. And this can be done by means of the well-established international practice of technical recognition, technical equivalence, and mutual recognition. For instance, finding an acceptable ratio for adapting the implementation of sustainability standards to different countries in the world. Obviously, this is something that we need to coordinate in the continent. And we, in FC4S, again, we have this regional platform, the African chapter, and our regional platform are really the backbone of our network. Now, at the national level, coming to Morocco. I'd like to thank all the representatives of the financial sector here in Morocco. I mean, many specialists, sustainable finance specialists. And thank you again for your commitment, continuous commitment to sustainable development. Let me just share with you one example of the innovative solution implemented by the Insurance Authority, ACAPS. Actually, 2 years ago, there was a new regime that came into force in 2020 on catastrophic risk insurance. And what is really innovative is that we have put in place a solidarity fund. I mean, it's composed by two things, a private insurance scheme and a public solidarity fund. And this solidarity fund is really innovative. And Morocco is one of the very few countries that have put in place this specific kind of solidarity fund to provide compensation to close to 5 million uninsured people and households in case of natural catastrophe. And I'd like to congratulate them for that. And, you know, this is the kind of projects that we would like to see replicated in our country and also in Africa. Well, I have a lot more to say, but I stop here. Again, I'd like to thank you all for your presence these last 2 days. I wish you all safe journey back home, and I hope you enjoyed your stay here in Morocco, and thank you.
Thank you very much, Lamia, for the closing remarks. And now, without further ado, it's time for the long-awaited ceremony of the first edition of the Young Academic Awards of the World Alliance of Financial Centers. I'd like to take the opportunity to reiterate our appreciation to all the jury members and Mr. Tamir Olfi, representing Casablanca Finance City here, present with us today. I'll hand it over to Akshu and Jochen for the ceremony. If you can join me on stage. Thank you. You have mics on the, or here, as you know. Please go ahead.
Centers, and I'm delighted and proud to present you the 4 winners of the first Young Academic Award of the World Alliance of International Financial Centers. We started this award early this year. It targets young researchers which focus on topics which are of relevance for financial centers. We discussed this morning sustainable finance is one of them, but we also face the digital transformation and many other issues. And we have invited them, young researchers under the age of 35, to send their papers to us. We got 60 applications, 49 papers from almost 30 countries all over the world. And again, I'm delighted that we can present you the 4 winners. You might ask yourself, why 4 winners? We had a distinguished jury, 8 jury members, and my co-moderator, Akshu Kampel-Holt, was on the jury as well. And yeah, we have a tied second place, exactly the same score. So then we were quick to decide, have 4 winners instead of 3 as originally planned. I hope you will not mind us this decision. Quite the contrary, we will have the pleasure to hear a 4th presentation. And yeah, without further ado, let me hand over to Akshu to say a few words and then call the first presenter to the stage.
Yeah, thank you, Jochen. And yeah, good morning or good afternoon, just about everyone. Thank you very much to Casablanca Finance City for this amazing week, bringing together such amazing people, great discussions, and such topical very important time as well. As we're in the midst of this global energy map disruption, I think we are having this critical dialogue here, and I hope to continue that later as well. So I thank Casablanca Finance City for making that happen. And while it's been fascinating to sit and hear about all the discussions on the need for capital, mobilizing of capital and capacity building, I think what YFC has also recognized the importance of further research that is needed to enable innovative solutions to be implemented, and in this context we have, I think, we've sort of established this inaugural Young Academic Awards, and it's highly relevant for us as financial centers as we look at disruption, as we look at creating new policy frameworks, new regulatory reforms. It's very important for us to stay on top of the new developments around the world. So it's been a pleasure being a jury member, and we've received, as Jochen has mentioned, we've received submissions from a diverse group of young academics, really rich in innovative thinking, providing novel solutions. And it is my honor to introduce our 4 winners. Firstly, I'd like to welcome Harshini Munaswamy to present her research and the paper. Of course, today I don't think they'll be able to go into a lot of the details because of the time constraint, but I'd like to reiterate how rich in this paper was in innovative solutions, novel ideas, and also sometimes challenging some of our conventional practices, which is, I think, so critical. So, Harshini, the floor is yours.
Thank you so much, Akshay and Joshan, for giving us this opportunity. Presenting myself, Harshini Munaswamy Elapa from the Open University of Mauritius, and my research is entitled on market reactions to the release of ESG news and sustainability reports in Mauritius. So the slides will cover the background of this study, the justification for this study, and the research aims, research methodology, and potential contribution. So there has, in recent times, scholars and practitioners have engaged a lively debate about sustainability, the concept of sustainability. And this question have led firms to engage to what extent do financial markets foster and facilitate more sustainability business practices through ESG factors, that is environmental, social, and governance factors. This growing demand led businesses to engage in sustainable business practices such as the publication of sustainability reports, and also eventually led capital exchanges to the development of sustainability indices to facilitate the investment in socially responsible companies. So this is an overview of ESG factors, which my research will be focusing on. Now, why this study? So the findings are mixed, as you can see, that there are negative market reactions to negative ESG news in Europe, negative market reactions to positive ESG news in UK, positive relationship to ESG controversies in Asian countries, and negative relationship to sustainability reports in Milan. As such, whether and how the publication of ESG news and sustainability reports impact the market reaction remains an empirical question. Secondly, there are limited and contradictory studies on how the market reactions to the release of ESG news and sustainability reports differ between companies listed in sustainability indices and non-sustainability indices. As such, there is a need to add more to empirical evidence to these limited but contradictory studies. And thirdly, studies to date are concentrated in developed countries with very few in developing countries and virtually none small island developing countries like Mauritius. As such, the call for investigation is to shift focus in a small island developing state like Mauritius. The why to this study brings us to the aim of the study to assess the market reaction to the publication of ESG news and sustainability reports on the stock exchange of Mauritius over 10 years, that is from 2012 to 2021. And the research also aims to find out if there is a difference in the market reaction to the publication of ESG news and sustainability reports by companies that belongs to the sustainability index, that is the stock exchange of Mauritius sustainability index and other companies. In terms of research methodology, I will just give a brief overview of it. So the research will be using two approaches, that is the event study methodology and the regression analysis over 2 window periods, that is +5 - 5 days and +10 - 10 days. And the sample size will comprise of 76 companies, both sustainable and non-sustainable companies. The potential contribution of this study in Mauritius, the market and sustainability in theories need to be investigated from a new geographical and cultural landscape, that is from a small island developing state perspective, that is from the Mauritius. And secondly, the concept of ESG is still at its early stage in Mauritius. Thus, the findings of the research will allow for the incorporation of ESG news, of ESG factors into the asset allocation of sustainable companies. Thirdly, the findings of this study will point to what extent some side, that is the stock exchange sustainability index, add value to the companies listed in this index. And fourthly, the issuance of sustainability reports in Mauritius is not regulated yet by an appropriate institutional bodies. So I thank you all for your attention, and this was 3 minutes, so I tried to cram all in this slide. Thank you everyone for your attention.
Thank you very much, Hashimi. I know it's hard to compress a long paper in 3 minutes, but you did great. Now I want to call to the stage Paul Momtas. Paul, the floor is yours.
Okay, I will be shorter. Thank you. As you can all read, the paper is titled Financing Sustainable Entrepreneurship, ESG Measurement, Valuation and Performance in Token Offerings. Thanks. And the study's objective really is to assess the impact of ESG on private capital markets, specifically SME funding and performance. So a key contribution of our study is that we develop a machine learning algorithm to quantify firms' ESG properties from text data, such as press releases, annual reports, and pitch decks. Our ESG ratings are very promising. They are highly correlated with those from Refinitiv, as you can see on the graph. Also, text-based ESG ratings will probably become even more precise as regulators and policymakers are proposing a standard ESG taxonomy sometime soon. With these ESG ratings for private companies in hand, we document 2 striking results. The first result is that yes, there is an ESG premium, there is a carenium. Investors are willing to value ESG firms in private capital markets higher than they would brown ESG firms. So in our result, if we think about our ESG scores, a 1 standard deviation increase in our ESG rating increases the firm valuation by 26% in private capital markets. So this is a significant ESG premium, which is probably good news, because firms are incentivized to adopt ESG goals in the first place because investors are willing to pay for them. The second result, however, is a little bit less optimistic. So high ESG firms underperform by 16% after the initial funding round. So if you if we compare brown and ESG firms, brown and green firms, we see that a 1 standard deviation increase in the ESG metric is associated with 16% lower investor returns in the year directly following the initial seed financing round. Okay, so what are the implications of this? Again, the first result is good because it says firms have an incentive to adopt ESG goals in the first place because investors are willing to pay for them. However, the amount investors are willing to pay for them is relatively large, 16% in terms of relative performance to brown firms is a relatively high number. So as long as investors are willing to pay that amount to finance ESG firms, we are all good. If that willingness to pay for sustainability is decreasing, then we would probably expect governments to step in and subsidize ESG. So thank you again to the jury for nominating my paper.
Thank you, Paul. Just before I invite Tristan, I just want to remind everyone that the papers of the winners are available on our website, wafc.com, and they're available to download. So next, I'd like to invite Tristan to present his paper.
Thank you very much. Can you hear me well? Yeah? Perfect. So, hi, I'm Tristan from the University of Mons in Belgium. I'm also part of the European Center for Research on Microfinance. And this paper that I will present today adopts a sectorial approach to discuss some regulatory and market conditions issues related specifically to the microfinance sector, especially when it comes to interest rate restrictions. So for those of you who may not know so much about microfinance, this is a sector, a formal industry which provides financial services to financially excluded people, mainly in developing countries, and also tries to provide these services in a financially sustainable way, in a profitable way, let's say. Some will say it is a beautiful tool for development, others will say that it has been much more mitigated than what we can think, especially because of some harsh debates that arise on high interest rates that are charged by microfinance institutions. In this context, the paper tries to assess the effect of a specific regulation, the restrictions set by governments on interest rates charged by microfinance institutions, especially so in this very specific sector. But we try to go a bit further with this paper by analyzing the effect that competition and market condition can have on the outcomes of such regulation. Why are we doing this? Actually, these regulations have spread very much in the industry these last years, but there is no cross-country study trying to understand the effect of this specific regulation in the microfinance industry. And there is no centralized data about interest rate restrictions in the microfinance sector. However, it is essential to give basis to regulators in order to better understand the consequences, the outcomes of their decision. How are we doing this research? Actually, we collected for the information related to interest rate restrictions, we collected by hand some data about the presence or not of interest rate restrictions in many countries. And we merged this data with some data from the World Bank dedicated to microfinance especially, but also with general data. We did a cross-country, statistically robust study, and we tried to explain the different mechanisms at stake here. So our findings explain that actually interest rate restrictions imposed in microfinance markets will actually drive microfinance organizations to propose or provide larger loans, which indicate actually that financial exclusion is exacerbated by this kind of regulation in the microfinance sector. In fact, some organizations will try to target better off clients, which are also less costly to charge to serve in order to avoid the regulation. But going further, we also show that competition, when it is high, can also exacerbate this detrimental effect of this regulation. And in conclusion, it is important for regulators to first, of course, understand the effect, the outcomes of their regulation, but also to have a broader analysis with market conditions and circumstances of their decision. So thank you very much for your attention.
Let me introduce the last presenter, Victor Saint-Jean. Victor, the floor is yours.
Okay, good morning, everyone. Thank you again to the organizers for the invitation. I'm very happy to present this paper today, which is entitled Exit or Voice, Divestment, Activism, and Corporate Social Responsibility. So, as you know, firms are under increasing pressure to adopt more sustainable business practices, and the role of shareholders is crucial. But today there is a debate among large institutional investors on what is the best strategy to promote that change. So we have, on the one hand, some investors who decide to use a threat of exit strategy, meaning that they divest from the bad firms. The objective is to reallocate capital to the good firms and incentivize the bad firms to become better. On the other hand, we have other investors who decide to use a voice strategy, meaning that they invest in all the firms or even target the bad ones, and they try to change them from the inside. So the objective of this paper is to assess which strategy is the most effective at preventing firms' antisocial behavior. So my paper can be summarized by this graph. So we have a mutual fund company, so I'm using US mutual funds data. We have a mutual fund company that manages a fund using outside investors' money. And through this fund, the company invests in different firms, so for instance here Apple and Wells Fargo, and they can use a threat of exit or a voice strategy that will influence a CSR outcome, which is in this paper, public controversies. So to assess whether an investor is using an exit or a voice strategy, what I do is that I use portfolio holdings data from standard data providers and AGM votes data. So I gathered all the votes of all mutual funds at all the AGMs of all firms in the US. And I can assess whether each company is using an exit or voice strategy. Then to identify the influence of the shareholder on the firm, I'm going to use large redemptions from outside investors from the funds, meaning that suddenly this fund has to withdraw its investments from the different companies. And this allows me to identify the effects of each investor on the probability that a firm has a controversy in the future. And so my result is that only voice can help firms to become more sustainable. I find that when an activist fund, a pure activist fund, is forced to sell 1% of a firm's equity, it increases the probability that this firm has a public controversy in the future by 1%. And when I focus on the bad firms with the lowest ESG scores, this effect increases to 5% and lasts for more than 15 months. And I do not find any effect on the threat of exit on firms' behavior. So bottom line, if you want to change a company, you should invest in it and vote at the AGM. Thank you very much for your attention.
Well, thank you very much to all the 4 winners, and thank you for being so patient as well. And this is, I think, the most awaited moment. Can I invite all the 4 winners, please, on stage, or three of them?
There's now the option to ask 1 or 2 questions to any of the presenters. Are there any questions in the audience? This doesn't seem to be the case. I hope I haven't overlooked any hand raised. Doesn't seem to be the case. Then we move on to handing over the prizes. Let's see whether it starts. My congratulations goes to Victor for making it to our third place. Thank you very much for all your contributions. Place comes with a prize money of 1,000 euro. Victor, thank you.
Now, as we started, we did mention how highly competitive this process was. And so the second place is joint, and we have two winners in the second place. So I'd like to congratulate, firstly, Harshini Munaswamy for the second.
I have the pleasure to announce the second winner of the second place. As I explained before, it was really tight. We had 8 jury members, and they all gave very detailed scores, and really even up to the second digit behind the decimal point, this was exactly the same score. This is why we decided to have second winners. Paul, congratulations.
And of course, that leaves us with the winner. Congratulations, Tristan, for winning this competition this year.
First place comes with a prize money of 3,000 euro, and I forgot to mention, of course, both of the second place winners will receive the prize money of 2,000 euros. Thank you again for your contributions. But we have one more thing to do. May I introduce you Bada Busabat, our head of marketing.
Hello everyone, thank you for joining this event. We also launched the social media prize. We wanted to know what's our audience preferences, and we're gonna now give some flowers to our winner of the social media prize award. And the winner is, Aishi, please, Kim, join us for the second prize.
But we want to share a little bit more flowers, and we want to thank very much our organizers and hosts from the Casablanca Finance City for all their hard work in the last weeks to make this possible, not only this awards celebration, but also our annual general meeting. Manal, thank you very much for all your efforts.
Thank you very much, much appreciated. This was not part of the script, by the way. It's a total surprise. Thank you so much.
And Lamia, please. Again, congratulations to becoming our new vice chair. But these flowers are for all your efforts in preparing this. Thank you.
Event. Again, we were really delighted to have you here with us this week. We wish you a safe flight back home. It was an absolute pleasure to be here with you today, and we wish you all a great afternoon, and we invite you to join us for lunch. Thanks again for your presence with us.